Good morning and welcome to our stakeholder event for the publication of our Annual Review 2025. I'm Huma Yusuf and I'm Head of Responsible Investing for our Financial Services Group at British International Investment. I'm delighted to once again be hosting this event. Today is about bringing our work to life, showing how our investments and partnerships are delivering impact on the ground and giving you the chance to engage directly with our leadership. This year's annual review, Impact in Action, reflects how, despite shifting global dynamics, we've continued to invest, partner, and deliver impact. Over the next 90 minutes, you'll hear from colleagues and partners across our markets, sharing how that impact is being delivered in practice. Whether that has meant creating jobs and expanding access to finance, or accelerating climate solutions and building more resilient economies. So let's take a look at today's agenda. First up, we have our chair, Diana Layfield, who will provide her perspective on 2025, the progress made, and our ambitions for the future. Diana will then hand over to our CEO, Leslie Marsdorp, who will build on that by sharing how we're delivering that impact through our investments. After Leslie's remarks, we have two exciting panel discussions, which I'm really looking forward to. Our first panel, a focus on Africa, unlocking sustainable growth, will come to us from Nairobi, Kenya, and will be moderated by my colleague, Freddie Tucker. He'll be joined by Seema Dhanani, our East Africa Regional Director, as well as two of our Kenya-based partners, Equator Fund, a venture capital fund focused on climate solutions, and Apollo Agriculture, a pioneering agri-fintech company. The discussion will aim to give you a flavor of the impact that BII-backed businesses are having in Africa. Following that, we'll return to London for our second panel, a focus on South and Southeast Asia, mobilizing private capital for climate investment. It will be moderated by my colleague, Jo Fry, head of our Capital Markets Group. She'll be joined by Holger Rothenbusch, our head of Infrastructure and Climate, as well as two of our partners. The Monetary Authority of Singapore, which is mobilizing capital to drive Asia's low-carbon transition, and EBVote, a renewable energy developer across South and Southeast Asia. This discussion will focus on the climate finance needs in South and Southeast Asia and barriers and solutions to private capital investment. After the panels, Leslie and Diana will return for the audience Q&A. This will be your chance to ask any questions you may have. So please start thinking about what you'd like to ask them and put your questions in the Q&A function at the bottom of the screen. We're expecting well over 500 participants today, so we'll do our very best to get through as many of your questions as possible. Now let's get started. To kick us off, I'm delighted to introduce our chair, Diana Layfield.
Thank you, Huma, for that introduction. And a very warm welcome to everyone here in London and all of you joining online. As Huma has said, please do send us your questions. We're very much looking forward to answering them later this morning. As I start, it's important to reflect on the context in which we're operating. The landscape for development finance is becoming more complex, more volatile, and more demanding. We're seeing widening development gaps, rising climate pressure, and increasing geopolitical uncertainty. Financing needs and expectations are rising, while resources are increasingly constrained. Long-term patient capital and partnership-driven investment has never been more important. In that context, British International Investment plays an extraordinary and distinct role. We back businesses and build markets, helping countries create jobs, expand access to essential services, and build their economies. Our approach is grounded in partnership, working alongside local institutions, businesses, private investors, and governments to deliver shared prosperity. And critically, it recognizes that development is not about dependence, but about enabling countries to shape their own futures. This year marks the conclusion of our 22 to 26 strategy period. It's a good moment to reflect on what we set out to achieve and what we've delivered. Over that period, we've delivered strongly against our commitment to productive, sustainable, and inclusive development. We've met our ambitious targets on climate finance and gender lens investing. We expanded into Southeast Asia, establishing a meaningful presence in a region undergoing rapid transformation. And we've driven tangible outcomes in the markets where we operate, real jobs created, services expanded, and opportunities unlocked. During my recent visit to Nigeria, I saw some of those outcomes firsthand. I saw Valency, an agribusiness company, expanding local cashew processing, ensuring that more value is retained in the country. I met the women working in the plant who spoke about the difference the job was making to their lives. It was inspiring to see how our investment is helping create thousands of livelihoods whilst connecting local farmers to global markets. And at Onergy, I saw how we'd helped this fast-growing solar company scale from a startup to a critical player delivering reliable, affordable power to homes and businesses, both reducing reliance on diesel and driving more productive local economies. An important part of our model is that we combine tangible development impact with financial sustainability. Our average annual portfolio return remains above 3%. This enables us not only to deliver impact, but also value for the UK taxpayer. We generate long-term returns, allowing us to recycle that capital and invest again and again. In a constrained fiscal environment, that ability to do more with the same capital is particularly significant. Also, by demonstrating that commercially disciplined investment delivers impact, we can help mobilize global investors into markets they would otherwise overlook. This is catalytic capital in action, where we unlock far greater resources for climate action, job creation, and economic resilience. And the value we create for the UK goes beyond financial returns. In an increasingly uncertain world, institutions like BII play a vital role in supporting global stability, and by extension, deliver a security dividend to the UK. Investing in the foundations of economic growth, jobs, infrastructure, and resilient financial systems, we strengthen economies in regions where fragility and instability can otherwise take hold. In doing so, we reinforce the UK's leadership in development finance, not just as a provider of capital, but as a partner, shaping markets and advancing a more secure and sustainable world. Accountability remains central to our work. We must be transparent in how we invest and around the impact we deliver. Over the past year, we've continued to strengthen our engagement with Parliament and the public and across our website. And we're proud that this commitment has been recognised. This year, we were named as the world's most transparent bilateral DFI by Publish What You Fund. While we're encouraged by that progress, we know that transparency is an ongoing commitment, not a destination. As we move into our next strategy period, the question is not only what we have achieved, but what more we can do. We know the world is becoming more fragmented and the needs of our partner countries are evolving rapidly. So looking to our new strategy, the board is focused on 4 things. Deepening our presence in frontier markets, those difficult markets which are most challenging for the world. Expanding our partnerships with global institutions, as well as those in Africa and Asia, to mobilize more global and local capital. Strengthening our role in climate finance. And fourthly, creating lasting market-level change, which extends well beyond individual investments in a country. These 4 priorities reflect a simple truth, that long-term development is built on shared ownership and shared prosperity. Leslie will share more about these priorities in his remarks. Before we move to Leslie's speech, I will show a short video highlighting some of the key points from last year.
Thank you, Diana, and thank you all for joining us today. It's a real pleasure to be here and to reflect on the past year and how we're positioning BII for what comes next. 2025 has been a year defined by change, by complexity, and momentum, from persistent inflation and geopolitical uncertainty to increasing pressure on emerging markets. These challenges continue to affect the countries and businesses that we invest in. But they also reinforce something fundamental, the importance of long-term, patient development finance. At BII, our impact must adapt and evolve to keep pace with this rapidly changing world. In 2025, that meant sharpening where we can make the greatest difference. Despite the challenging environment, we continue to deliver at scale. In 2025, we committed £1.8 billion, seeking to make a positive difference on people's lives and on the planet, with £1.1 billion committed to Africa and £0.7 billion in Asia. These investments support more and better jobs, improving economic opportunities, and providing greater security for individuals and families. They also help build a thriving private sector that can generate the tax receipts governments need to build infrastructure and provide public services. In 2025, our portfolio supported over 1 million jobs directly. We supported jobs by improving access to electricity and finance and supporting local wages as well as supply chains. And our investees paid $5.5 billion in taxes. At the same time, we met our climate and gender investment targets. We backed businesses that channel funding to female entrepreneurs, and we partnered with companies to improve opportunities for women in the workforce. In 2025, we committed £585 million of gender finance, equivalent to 33% of our total commitments. This week, of course, is London Climate Action Week, and it's been clear to see the leadership role that the UK is providing on climate finance. We're very proud to be the UK government's largest providers of climate finance to emerging markets and developing economies. In 2025, we committed £827 million to climate projects. That represents 45% of our total commitments. But beyond those numbers, it's important to highlight the individual examples of exciting, innovative companies that are making a difference. Over the last year, I've been privileged to have a chance to meet many of those businesses having an impact on people's lives. From Nairobi to Cairo, from Mumbai to Lagos, every time I travel and sit with founders and entrepreneurs behind our portfolio companies, I'm reminded of why this work matters. Their resilience in the face of real adversity, currency devaluations, infrastructure gaps, and many other challenges. This is not abstract courage. These encounters are the most clarifying moments in my work. Over the past year, our experience has sharpened our view of where we can have the greatest impact. That has translated into 3 key areas of focus, from which the foundation of our new 5-year strategy, which we launched a couple of months ago. Importantly, our 2025 achievements show we are already beginning to deliver against these areas. First, we've gone deeper into frontier markets. These are markets that are often outside the investment horizon and geographic focus of your traditional commercial investors. In these markets, capital is scarce and the risks are often perceived to be high. You will see examples of this in our report, like our support for Acumen's Hardest to Reach initiative, where our fund investment is helping expand access to renewable energy in countries where electricity access is often as low as 12%. We've continued to back the Africa Resilience Investment Accelerator, or ARIA, working with development partners to de-risk private sector investments in these frontier markets. These investments require patience, but they unlock transformational and long-term change, and it will continue to be a priority for BII in the coming years. Second, we have prioritized mobilizing private capital at scale. BII balance sheet alone will never be enough to meet the scale of today's development and climate challenges. We need to galvanize private capital at scale. So we're working with global investors, with asset managers and institutions to bring new capital, fresh capital into emerging markets. So unlocking private capital and stretching public finance further was a priority for us in 2025, and it will continue to be a top strategic priority for BII in the years to come. I was pleased that we mobilised £1.7 billion of private sector capital into our investments last year. We also became an anchor investment in the Allianz Credit Emerging Markets Fund, which is a landmark blended finance vehicle targeting up to $1 billion in investment. At first close, this fund already secured $690 million. And in Southeast Asia, we deepened our partnership with Pentagreen through a commitment to Green Investment Partnership, a blended finance vehicle within the Finance Asia's Transition Partnership, or FASP as it's called. Our commitment is helping to crowd in private investment, and we'll hear more about this in one of the panel sessions later this morning. We're also supporting the mobilization of domestic capital, for example, through partnerships with pension and investment institutions in Africa. In 2025, we built on the success of Growth Investment Partners, or GIP, in Ghana by launching a GIP platform in Zambia in partnership with Zambia's largest pension fund, the National Pension Scheme Authority. We also formed a partnership with South Africa's Public Investment Corporation, or the PIC, which indeed is Africa's largest asset manager. And we did this to channel domestic institutional capital into high-impact businesses across the continent. And importantly, we continue to recycle capital, exiting investments at the right time to demonstrate commercial viability and enable private sector to step in. Third, we are placing greater emphasis on market-level impact. Individual investments, of course, remain critical, but our ambition goes further. We want to help build entire sectors, strengthen competition, and create lasting change beyond a single investment. For example, the expansion of WorldLink in Nepal has improved both affordability and service quality for over 1 million customers. This demonstrates how investment can reshape a market. And we are applying lessons across geographies, from electric mobility in India to replicating similar approaches in markets like Kenya. Our ambition is not only to support individual companies, but to help entire industries to thrive. None of this, of course, happens in isolation. As we look ahead, one of the clearest lessons from the strategy period is the importance of partnerships and collaboration. The scale of the challenges we face simply cannot be addressed by any one institution alone. They require collective action. Collaboration with other development finance institutions, with governments, with private investors, allows us to share risk, allows us to scale capital, and allows us to deliver greater impact. I'm pleased there are examples of where we are already doing this. But as we look into the future, we will build on this strategic collaboration with partners from the development finance institutions to multilateral banks, as well as the institutional investor community. We have taken time to reflect on our previous strategy. We looked at what has worked, where can we improve, where can we indeed have the greatest difference in the years ahead. Those lessons are now shaping our next 5-year strategy. So what do I take away from 2025? I see an organization that has adapted to a changing world, that has delivered meaningful impact and positioned itself strongly for the future. I see both ambition, but also clarity of purpose. Above all, I see a team deeply committed to making a difference, and I want to end by thanking the team at BII. Their dedication, expertise, and commitment are what makes this possible. I also want to thank all our partners and our investee companies. You are the ones delivering real impact on the ground, often in the most challenging environments. I'm now pleased to hand you over to the first of our 2 panels to delve deeper into the annual review and the impact of our investments. Our first panel comes to us from Nairobi, Kenya, where we will explore with some of our BII team members and our investee partners how we're unlocking sustainable growth. But before I hand you over to the panel host, Freddie Tucker, we'll start with a short film which introduces some of our key investments in Africa from 2025. Thank you.
I first started with a normal combustion bike. Then the past 2 years, I've been using electric bike. It's more efficient because there are swapping stations all over, and then I can save a lot of money. And it's also cheaper on spare parts.
Working at FAY International has really helped me get employed, and also it has helped me with my daily bread, and I'm able to provide for the family as well.
Ethiopia had only one telco operator for 130 years. The first impact for sure is that we have given people the opportunity for choice. So it has become a very competitive market where ultimately the customer gets better value for less money. So generally it has been a great impact for the consumer.
The income that we are getting through the outgrower scheme Zambia has helped us to do more. We've become now stable employers, providing quality jobs for a continuous period of 12 months of a year. So in terms of impact, it's huge.
Thank you to London, and welcome to everyone watching, wherever you may be in the world. I'm Freddie Tucker, and I'm speaking to you today from Nairobi in Kenya, one of BII's regional offices and a city at the centre of Africa's innovation story. Kenya is a gateway to Africa and is also a city where ideas are being built, funded and scaled with phenomenal pace. And it's not just in Kenya. Africa sits at the centre of one of the defining global opportunities and challenges we face today. It is highly exposed to climate risk and yet receives limited global development funding. And at the same time, there are innovative businesses being built here every day. We have M-Pesa at the forefront of global payments, Trade Depot leading in e-commerce, Lumos in solar home systems. It's a place where businesses really are scaled and grown. So today we're hosting a discussion that really focuses on this. What is sustainable growth in Africa? And we are very pleased to have on our panel voices from the investment side and also from on the ground operational side, which we're really looking forward to talking through. So first off, I'd like to introduce, we have David Longdon, an investor from Equator VC. Very pleased to have you here. Over 10 years in finance and investment, raised over 55 million for the Equator Climate Tech Fund, including 5 million from BII, and focusing on energy, agriculture and mobility. We also have Benjamin Njenga, co-founder and CCO of Apollo Agriculture, founded in 2016 to help small-scale farmers maximize profits. And one of the most interesting things is that Apollo farmers have 2.6 times better output than the average Kenyan farmers, and reaching 2 million farmers across the country. Thank you for being here. And I'm also delighted to welcome my colleague, Seema Dhanani, Regional Director for East Africa, who leads on all our investments and strategy across the region. Seema brings a perspective of on-the-ground investment experience and how BII can unlock capital and support market development. So between them, I think this panel reflects the entire value chain, everything from early stage investment, scalable growth, and the realities of on-the-ground operation. So let's get started. Perhaps, Seema, we could start with you. What are you seeing are the strongest signals of sustainable growth in Africa today?
So I think if I look at the region, Freddie, East Africa is one of the most exciting places to be and to really make investments that sit at the heart of people and impact and the planet. If I think about the sectors that are exciting for us, it's really about climate and climate sustainability and how we can support that. Secondly, it's agriculture, absolutely fundamental for many of our economies in this region. And then it really is about financial inclusion and how we can support those systems. So if I think about the climate aspect, we sit in economies here where it's real, it's tangible. Drought affects all of us, not just the smallholder farmers, but the impact in terms of food security is felt in the cities as well. So it's the the whole process around agriculture is absolutely critical, and climate and the interaction between those two. And financial inclusion, goes from the sort of the large-scale banks that we support. If we think about Equity Bank that we supported many years ago, they were at the sort of fundamental core of financial inclusion and helping to grow that. You mentioned M-Pesa. That is a critical resource and tool that we've been able to harness and use to create and help small businesses across Kenya and slowly into the rest of East Africa to help them scale and grow. And it's really about also, the inclusion piece there is really about, looking at those who are underserved. So gender-based companies, right? Female entrepreneurs, and how the small sort of mama boga on the street can use M-Pesa, can use mobile banking to really help her not only grow for herself, but support her family and to provide for her children's education. One of the things that you find in East Africa compared to many other parts of the world is really that we're not just digitalizing infrastructure that actually exists. We are building infrastructure. You're really having to think about how these systems work right from scratch. They don't exist for us today. And I think that's what's quite exciting, because you are able to jump technologies, to build things that really work for our economies today. So that's absolutely critical for us. And at the core of what we're seeing in East Africa is that combination between people and planet. I think traditionally we've seen, or we've thought about impact as being, completely exclusive to commercial return. And what's exciting here is that we have businesses that, both serve people through inclusion and are showing that we can make sustainable commercial return.
And there's a lot of interesting themes there. You mentioned scale a lot, small businesses, talking about how we can build the next generation of climate technology businesses. Now, David, this is very much within your wheelhouse. So before we can sort of get into that, could you perhaps start by telling the audience about Equator?
It's a pleasure to be here. Again, my name is David Longdon. I'm an associate director at Equator, which is an early-stage venture capital firm that invests in tech-enabled businesses that are driving climate adaptation, resilience, and mitigation outcomes in sub-Saharan Africa, with a specific focus on some of the core sectors, some of which Seema mentioned, including energy, agriculture, and mobility. Equator invests to invest in what we believe is a critical juncture in the life cycles of early stage companies, the gap between initial proof points and the growth stage capital that really allows businesses to scale. We do that by a thesis-led approach, and so developing a prepared mind around the businesses that we evaluate, and really helping to drive conviction and being able to lead some of these transactions that provide that critical funding, as well as bringing groups of co-investors and follow-on investors along for the journey. This conviction has allowed us to lead or co-lead most of the 9 companies that we've invested in so far. Those companies operate across 15 different African markets, and since the point of Equator's investment, have raised over $170 million in capital, which is a 12x multiplier on the capital we've invested. So very excited to be part of this journey and to be here.
So you're very much at the early stage of the capital stack, before the growth investors come in. When you're looking at these businesses, what do you look for, both in terms of impact on people and planet, but also from the commercial side and how they're going to scale to be continuously sustainable?
We do have that dual mandate. And as we think about evaluating businesses, we are fundamentally looking for genuine movement as it relates to climate mitigation or adaptation and resilience. And so each incremental customer, each incremental product delivered is moving the needle on one of those outcomes, as well as pairing that with sound unit economics and strong commercial viability. These companies are typically built by very ambitious and experienced founders, and that are operating in large markets that may or may not be underserved, but have very deep economic as well as climate resilience outcomes and climate adaptation, resilience, and mitigation outcomes. And maybe just by way of example, you think about the fact that 80% of distributed renewable energy projects on the continent fail at the feasibility stage. One of our portfolio companies, Odyssey Energy Solutions, has developed a platform that de-risks the financing and development of distributed renewable energy projects on the continent. So far on their platform, they have over $3 billion in capital that is targeting over 3,500 distributed renewable energy products that are both providing clean, reliable power to businesses and to households, moving the needle again, as I said, on climate outcomes as well as economic development. Another example in the agriculture space is a portfolio company called Sun Culture that provides solar-powered irrigation services, combines that with pay-go financing as well as insurance to help move the needle between an ecosystem that is largely an agriculture ecosystem that is largely rain-fed to one where smallholder farmers are really able to access groundwater and do that through avoiding the use of diesel-powered water pumps.
Those examples are really helpful because I think so much of this is about the on-the-ground realities and what the operators do. You know, we sit at the investment side of things, but, you know, we have people like Ben here who are actually on the ground dealing with some of these challenges and really seeing them face to face. So, you know, I expect we're about to get a bit of dose of reality here, but perhaps you could start by telling us a bit about Apollo Agriculture.
Yeah, for sure. Thanks, Frederick. And we started 10 years ago. And our goal and our mission is to support farmers to make more money. And we do that through supporting the smallholder farmers have everything they need to be able to succeed. So if at all you are a maize farmer, you are doing 1 acre in Kitale, we'll be able to give a very perfect agronomic package that you need to be able to double or triple your production. So we give seeds, that is high quality seeds. We give fertilizer, we give insurance, just in case of a bad season, you're able to get an insurance payout. And also we bundle agronomy advice. So we have field officers on the ground who will be able to visit the farmer to be able to train on the agronomy side. And above all, we also bundle financing so that at least that farmer can be able to afford all those inputs at planting and be able to pay slowly over time via mobile money. And that will allow that farmer to be able to pay the loan at the point when they are able to harvest the produce and be able to pay back. We know most farmers, they are aware that they need to be able to use fertilizer, they are aware they need to use high quality seeds, but most of them struggle really to raise the investment. The problem is really to get those products on farmers' hand and be able to invest in them. Most farmers don't have a bank account, they don't have any financial records. So if at all you are thinking around how to give financing to these farmers, you have to do a bit differently. So a paper and pen business model won't be able to work, but we have been able to build technology, and I think this is where our innovation is. We have been able to build technology through remote sensing, machine learning, AI, all the way how we do the customer acquisition, how we do the lending decision through credit model that are able to evaluate different data sources for those customers, including how we do advisory and even repayment and corrections through mobile money. That help us to keep the transaction low and be able to really finance that smallholder farmer with 1 acre in a way that is commercially sustainable.
Wow. So we talk a lot about climate resilience in the DFI world, and especially in agriculture. What does that mean for you and for the farmers on the ground? How are they thinking about, or how are you thinking about and dealing with climate resilience?
Climate change is something that is really a big impact to the smallholder farmers. I feel like they're on the edge in terms of how the impact their economic lives. And I think from what we do is that we're able to incorporate that strategy in terms of what we do for our farmers. Just a very simple example, Fred, is that even my mom and any other farmer on the ground, they're still planting their maize seeds the way they used to plant 10 or 20 years ago. They still plant in March without knowing that climate change has come and moved some of those planting timelines. So what we have been able to do is really, once you build the trust and the relationship, I usually say for farmers, some of these things are emotional for them. Is feed on the table, is school fees for their kids, for them to do a transition in terms of behavior, that has to take trust and relationship. So we have been able to build that trust and relationship. And what we do is that even in the package, we tell the farmer, you're used to do this seed, but on the side, have a different plot and do this high value drought resistant variety. So they're able to see the comparison, and we are able to bring even financing so that they can be able to afford it. In addition to that, we also know that as we try to support the farmers with adaptation, they still suffer the economic shocks around it. So I remember last year in 2023, we had a very bad drought in Zambia, which it had 99% kind of impact. So we bundle insurance, and that helps the farmer. In a case of drought, we are able to transfer the risk to the financial market. So those farmers were able to get an insurance payout, cleared their loans, and they're able to go back again in terms of farming. So that also include even a lot of training around climate resilience. And also we are looking also to more partnerships with other partners on the ground. Like for now, we have been able to bundle irrigation systems into our package. So a farmer would like to do onions, but also they want a water pump, they want some drip irrigation, and that enable farmers to be all round in terms of climate resilience.
I mean, these are fantastic success stories we get to hear direct from yourself, but also examples like Sun Culture in their Equator VC portfolio. I think what we sort of talk about a lot as DFIs is market shaping, market moving, how we actually move economies. So the question becomes, how do we move from isolated success stories to more ecosystem building and growth in that respect? It's a question to the whole panel, or maybe Sima, you could kick us off on this one, is, what needs to change? How do we go from these isolated stories to ecosystem development? How do we really build out more than the odd case?
So that's a really big question. I think one of the fundamentals is around patient capital. David mentioned that, actually, yes, it's patient capital, but David, you mentioned, it's actually where that capital sits. I think we're in a region and an economy where we do see a lot of capital come to the table, but it's, patient at which stage? And the stage that David mentioned was that early stage. How do you help someone like Ben? And if I take you back 10 years, when you first started, it's that point of, inflection of actually testing your pilot, getting through your feasibilities. And then when you're ready to scale, where is that capital that's going to take you through to the next level? And I think that's the challenge. How do we support some of these wonderful entrepreneurs that we see in this economy to really take their ideas, their innovation to the next stage, and where we can help them get to some sort of commercial viability where the capital that exists today can really start to come in and help to sort of scale. So I think that's one of the big things. We are, at a huge advantage in this economy where we don't lack, skill sets from entrepreneurs. We have amazing entrepreneurs. We have people that are very, very well trained. And we have, therefore an abundance of local talent to put this to work. So I think those are, some of the ingredients that we do have, and that sort of patient capital at the right stage is really critical.
David, Ben?
Yeah, and maybe just to fully agree with Sima on that in terms of patient capital, some of the challenges you face right now in building in these markets, they really take time. And I think you have to really have partners and investments that have a more long-term approach because you have to really invest, and maybe the results of those investments will take time. There is also a lot of kind of iteration along the way. Like when we started in Apollo, we thought we'll be able to digitize everything, automate everything, and be able to make it more scalable. But over time, you find this doesn't work. You have to generate a lot of data for you even to be able to get at the level of credit models that will be able to predict repayment. For now, at least in Apollo, we are proud with what we have done. So far, we have been able to finance over 400,000 farmers to date. with a loan portfolio of around $85 million. That is across Kenya, Uganda, and also Zambia, and supporting different value chains. Like I'm proud in Uganda, we are supporting some coffee value chain farmers, and there you find like the national average production per tree is around 0.5, and they have the potential to do 10 to 12 kilos. And what they are missing is really the inputs and the financing and the advisory to be able to approach that. So guess like if at all we were even able to achieve half of that, like the impact of it is huge in terms of the money it unlocks for the farmer, but also the GDP it kind of unlock for the country. So we are looking forward to see how do you make those investments, how do you have the patience, and also how do you try to find local solutions.
I think particularly your point around wanting to digitize everything and realizing that doesn't work. You know, we see here so much is still done in analog, paper-based systems, cash changing hands, you know, very different from some of the other markets we see in the world.
Maybe just to double click on two things that have been mentioned. One is the fact that you also very much do need different types of capital within the capital stack in order to support these types of companies. And there are several different ways that non-equity capital can come in to support ventures, allow them to build the scale that achieves both impact as well as economic outcomes and things that debt and other forms of non-dilutive capital can achieve. And maybe the other phenomenon is more risk capital. And so what that means, and if you think about the fact that in 2025, there was around $4 billion in capital that flowed into venture-backed companies, a mix of equity and debt, and that was a 25% increase from the prior year. Around a third of that was into climate tech companies, which was fantastic. But the interesting phenomenon that we saw was you had a little bit more concentration in slightly later stage, larger transaction sizes. And so what that means is the gap between sort of earlier stage and later stage companies widened, which is the gap that we exist to try and fill. And so more risk capital, looking to fund businesses and founders that are continuing to innovate, that really are developing solutions using a combination of technology innovation as well as business model innovation, like Benjamin is doing at Apollo, that are really driving genuine economic growth on the continent and can be drivers of economies long term.
If you look at the agricultural sector, you find like, and in respect to the climate change agenda, you find like for us to be able to achieve that climate change transition, it requires a lot of behavior changes. Like for example, if you want to change someone from planting a variety, like today most of the farmers do like a popular variety called Kenya C6213, is 20 years old technology. So it's not adapted to current drought challenges and all that. But for you to change that, you have to do a demo for a whole season in the same environment that the farmer can be able to see. So that will take like multiple seasons for it to be, for farmer to be able to transition. And that is why I agree in terms of like trying to also get capital mixes that also understand that some of the things for us to see results will have to take time.
Freddie, if I can add, I think over the last couple of years, what we've been able to do as BII is to inject some concessional capital through a strategy called Kinetic, which has really played a fundamental role in market shaping some of the electric mobility sector that we've seen grow substantially across the region. And we've been able to support companies like Rome, which is in the Equator portfolio, Bazigo, Arkwright, etc. But if we weren't sort of able to support some of these companies start to grow at sort of this early stage, you know, then we're never going to get scale, and we're never going to transform the way the transport sector is working across the region. And so I think, you know, our investment at the right stage across this new ecosystem is really fundamental to hopefully what we'll see in 5 to 10 years, you know, and also being there at the right time to support different transition stages. So now, you know, you're seeing the cost of batteries come down, you're seeing technology in batteries change. You know, we're seeing how the infrastructure to support the electric mobility sector in this economy shift. all right? And, we've got battery swapping stations now. We've got interoperability happening, which is great. But this is all sort of, pushing the sector ahead.
Listening to this, it's clear there's no sort of one silver bullet solution to this, but patience and the ability to understand the ecosystem and go with the ecosystem, whether it be in agriculture or Seema, as you say, in EVs, we have to have that patient capital at all points in the capital stack.
I think, as we think about the point of investment is really the start of the marriage, the start of a very long journey. And that partnership involves a lot more than capital. It requires being able to provide strategic advice and counsel to founders. It involves helping formalize governance as companies move from initial early stages to trying to attract later stage, larger institutional capital, helping execute and develop ESG action plans and business integrity action plans. A lot of the day-to-day things that really keep founders up at night. We love to say we want to get the phone calls at 10 p.m. on a Friday night around business challenges that you have, because that is what it means to be an early stage investor, separate from writing the initial check.
So I think that's the last question, but before we wrap up, we have a tradition in our Nairobi office where we start each meeting with one word on how we feel before we start that meeting from each individual around the table. So I was wondering if we could keep to that tradition, but amend it slightly. And for this panel, if you could each close with giving me one or two words just on how you feel about the investment climate and the business going forward and the future of sustainable businesses in Africa. Perhaps you could start.
Incredibly excited.
Very good.
You stole my word. Optimistic. Let's go with that one.
Great to hear.
Actually, you took my one also, but I feel like there is a lot of support around us in terms of us to succeed and continue building.
Good. So a very positive outlook, it seems, which is great to hear. But we must all be patient and offer that patient capital. So thank you very much. And we can pass back to London.
Thank you, Freddie, Seema, David, and Benjamin, for those insights and that engaging discussion. Before I introduce our next panel, a quick reminder to send in your questions for the Q&A with our CEO, Leslie, and our chair, Diana. And now, on to our next panel. This session dives into an area that has become an increasing focus for us over the last year or so. Unlocking the trillions needed for climate action in South and Southeast Asia will depend on mobilizing private capital at scale. In this session, we'll explore how BII is already doing this in practice, drawing on real examples of partnership and blended finance to crowd in investment and accelerate climate solutions across the region. Before I hand over to panel host Joe Fry, we'll start with a short film which introduces some of our key investments in Asia from 2025.
इलेक्ट्रिक बहुत अच्छा लगता है चलाने में EV व्हीकल्स बहुत कम पैसों में बहुत दूर मतलब ट्रैवल कर सकते हो
ನಾವು ಡೇ ಮಾಡಲಿ ನೈಟ್ ಮಾಡಲಿ ಯಾವಾಗ ಬಂದ್ರೂ ಗನ್ ಖಾಲಿ ಇರುತ್ತೆ ಚಾರ್ಜಿಂಗ್ ಝೋನಲ್ಲಿ ನಾವು ಏನಂತ ನೈಟ್ ಮಾಡಿದ್ರು ತುಂಬಾ ಯಾವಾಗ ಬೇಕಾದ್ರೂ ಬಂದು
ಈಗ ನಮಗೆ ಡೀಸೆಲ್ ಪೆಟ್ರೋಲ್ ಇವೆಲ್ಲ ನಾವು ಇಷ್ಟು ವರ್ಷ ನೋಡಿದ್ವಿ ಈಗ ಹೊಸದಾಗಿ ನೋಡ್ತಾ ಇದ್ವಿ ಚಾರ್ಜರ್ ನಂಬರ್ 1 ಬೆಸ್ಟ್ ನಮ್ದ್ರಲ್ಲಿ
We partnered with Sky Renewables to have installation of solar panels in our facility. We have an upcoming expansion. So on our expansion, we also incorporate solar panel in the design so that overall we can achieve around 30 to 40% reduction in our consumption.
हमें भी ये लगता था कभी अपना घर हो जाए तो अच्छी बात है विचार तो मेरे को हो गया 2-3 साल पहले से मगर नहीं ले पाए फिर बीच में कोशिश किए तो आदमी ख़त्म हो गया इसकी वजह से फिर 1.5 साल फिर लटक गया मैं शुभम के पास गई वो मतलब कोई फिर इंक्वायरी नहीं कोई दिक्कत नहीं आराम से मैं अभी अपने घर में हूँ, मुझे बहुत अच्छा लग रहा है यहाँ पे।
Yang pertama, tanaman padi saya lebih sehat. Yang kedua, lebih tahan penyakit. Dampak yang kami rasakan adalah meningkatnya pendapatan.
Welcome back to London for our next discussion. We're going to be focused on South and Southeast Asia, a region at the centre of the global climate transition and home to some of the world's fastest growing economies. We'll be talking about what it takes to mobilise more private capital into the climate space across the region, and we'll try and give you a flavour of the opportunities, some of the barriers that still need to be overcome, and how working with the right partners can help turn ambition into investable projects on the ground. I'm delighted to have a fantastic panel here with me to help explore these topics. Firstly, delighted to be welcoming Gillian Tan from the Monetary Authority of Singapore. Gillian will bring her perspective on how Singapore is working with partners to mobilise capital for Asia's climate transition. This includes initiatives like Financing Asia's Transition Partnership, also known as FAST-P. This initiative aims to bring together different sources of capital from public, private and philanthropic sources to help finance Asia's green transition. We're also joined by David Ludwig, CEO of IB Vogt APAC. He will share a developer's view on the renewable energy opportunity across Asia, drawing on IB Vogt's experience in the market and your own experiences across the region. And I'm also pleased to have Holger Roslenbusch, my colleague from BII. He heads up our infrastructure and climate team, and he'll bring his perspective from BII's experience within the markets, giving us more background on how BII has supported climate investment across the region, and also how we've worked to bring private capital alongside BII. So firstly, to Gillian. I briefly touched on FAST-P, which was created to help address Asia's climate finance gap. If you could tell us a bit more about the climate finance gap in Southeast Asia and why addressing it is so important.
Thanks very much, Joe, and big thank you also to BII for having me today. You asked why Southeast Asia. Excuse me. I think the reality is that Southeast Asia as a region is going to be one of the most consequential growth stories of the next decade, right? So close to 700 million people. Collectively, I think we are now Southeast Asia's we're the world's 5th largest economy. And you know, the demographics and other macroeconomic factors really speak to amazing growth in the region. With growth and change in demographics will come a massive need for energy transition and sustainable infrastructure development. On energy demand alone for Asia, we expect a 60% increase between now and 2040. So that's absolutely massive. If you double click into Southeast Asia specifically, you're looking at something like $130 billion for the energy transition between now and 2030. So really significant. So we set up FAST-P with 3 goals. The first is really capital mobilization, the second is coordination, and the third is just making sure the whole thing was repeatable. So just on capital mobilization alone, FAST-P is a $5 billion blended finance vehicle. The Singapore government put in $500 million of concessional capital, but the requirement is that it be matched dollar for dollar, one for one, with concessional capital from other providers. The idea is that $1 billion worth of concessional capital then crowds in 4 times at least of commercial capital, which makes up a $5 billion platform for sustainable and transition investments in Asia. So, you know, we've had some success and we're very grateful for BII's close support in all of this. One of our funds, the Green Investments Partnership, recently announced second close at $800 million, which is substantial. And, you know, just this week in London Climate Action Week, another one of our funds, the Energy Transition Acceleration Fund, also announced first close at $250 million. So we're very grateful for that. But to be honest, it's actually not so much the money that is of note, I think, but the range of partners that have come into this vehicle. So on the DFI side, as I mentioned, BII, really strong anchor investor there. We've appreciated that. We have other DFIs, including the Australian DFIs and many others, including some of the European ones, have come in strongly there too. We've got the philanthropies, and we've got sort of senior capital providers that might not otherwise have looked at a product like this, such as DBS and BPI. So that's capital mobilization. The coordination piece is also very important because platforms like this allow for quite different parties to come together and actually sort of hammer out details of a deal, of a platform, understand each other's requirements, and I think that's built trust. And it's been interesting because we've seen some partners come in on one fund and then feel comfortable enough to jump in on the second. So I think we'll see more and more of that, which brings me to that last point, which is repeatability. At the end of the day, for us, it was very important that we move from a transaction-by-transaction approach to a platform approach, which is what we've done with FastP. So, you like the fund manager, you diligence the manager, you understand the investment focus and thesis, and then you let it go and let the fund manager who knows the region well do his thing and do all that needs to come with that. And that's very important. But one last point is that if I can be very ambitious, I think we actually need to stretch this further, right? So beyond sort of just bashing things out at the platform level, we need to actually find a way to agree on a way of doing these platforms and structures so that this is repeatable again and again. And we're not sitting there having bespoke negotiations again and again.
And I guess you've touched on it a bit there on the replicability, but as you aim to bring in more private investors into climate finance in Asia, how do you see that working?
Yeah, it's a great question, and it's actually what we've been spending a lot of time thinking about lately, that need to bring in mainstream institutional investment into climate finance. And I think here, if it was a Sesame Street, the letter of the day would be P, because really it comes down to 3 Ps, right? PR, or public relations, products, and participation. So PR, what do I mean? The truth is, we love blended finance, but actually blended finance has a bit of a PR problem. So institutional investors, the folks that maybe don't come to London Climate Action Week, can be a bit suspicious of what blended finance is. So through the FastP process, we realized when speaking with institutional investors that some of them thought that the fact that you need a blended finance sort of wrapper around these investments means that there must be something wrong with these investments and therefore need blending or a subsidy to make them okay. And we need to shift that mindset, right? From concessionality or subsidy to investability. And that brings me to the second P, which is products. And what I mean here is that, we really need to think about how we sell this and package this product in a way that institutional investors understand. So rather than saying, oh, hi there, here's a blended finance opportunity for you, which, a pension fund or a large asset owner may not understand. You need to say, here's an investment grade debt product. This is the target yield. It's got, amazing downside protection for the senior tranche, and, wonderful governance and standards because BII is involved, right, among others. So, we really need to shift that focus and meet mainstream investors where they are, and we'll unlock a lot of capital if we can do that. And the final P is participation. And really, this must be the first step. I've walked into many rooms at London Climate Action Week this week and been privileged to be at roundtables. Very often, it's kind of the same community. We all know each other very well. But the private sector, the large banks, the large institutional investors have been somewhat underrepresented in some rooms. We need to change that.
No, thank you so much, Jin Yan. Absolutely. And maybe moving a bit more to where the capital is deployed to, David, could you briefly give us a bit of an overview of what IB Vogue does in Asia and tell us a bit about the opportunities you see in the renewable energy development space?
Sure, and thank you for having me here today. Yeah, so IB Vogt is originally German, European-based developer of renewable energy, mostly solar and battery storage. And in Asia, we're active actually for the last 10 years and fully committed for the last 5 years to set up a dedicated platform that is really focusing on Southeast Asia. Southeast Asia for us is basically a mix of 5 countries, predominantly the Philippines, Indonesia, Malaysia, as well as Vietnam and Thailand. So over the last 5 years, we've been active in the development mostly of solar and battery projects. And yeah, last year we have been privileged to start working with actually both BII and the Green Investment Initiative, Pentagreen, who have funded a very transformational loan that we have received into our platform that enabled us to really kickstart the construction of large assets in the Philippines.
Great, and I guess you mentioned there the $80 million facility with Pentagreen and BII supporting solar and battery storage. Kind of why does this type of financing matter for moving projects from development into construction?
Yeah, so over the last years, we've seen actually big movement in Southeast Asia in terms of both government and private sector offtake auctions, where we could secure relatively large power purchase agreements. And while actually Southeast Asia is relatively developed from a senior project finance perspective, so in all our markets, we don't see any major issues to secure project finance on actually from even local banks. So the banking market is very well developed. However, the struggle, I think, for an earlier stage platform that we were definitely maybe 18, 24 months ago, is to really mobilize more capital on the equity side. And there, I think we as a smaller platform that is not backed by a major fund, struggle to basically get our initial capital to start building a sizable portfolio that we can own and then further expand. And I think this loan was very critical for us because it's an 80 million facility, but in the end it will be fully deployed by end of this year, and we will mobilize more than 400 million of project finance against those 80 million. And I think that goes to what Gillian is saying, that it's basically catalyst that is required to really then get projects into construction.
No, that's great to hear, right? It's a kind of missing piece of capital that as the projects are developed and functioning, obviously you can get bank financing. But great to hear how we're filling some of the gaps, hopefully, across the market. Holger, moving to you. BII has obviously been active financing in the climate space and across South and Southeast Asia, including partnerships like the one we've just discussed. But can you tell us a bit about your experiences and BII's experiences in the market and a bit about how we're thinking about mobilizing commercial capital across these markets?
Yeah, of course, and delighted to be here and being joined by friends and colleagues. I would very much sort of build on what David and Julian had said, and using the PPP that Julian mentioned. I mean, as a DFI, we are very much looking at what's the problem and what's the product and who are the partners that we need to work with. And so the problem, clearly, Julian outlined very clearly. The challenge in South and Southeast Asia is significant with regards to the energy transition that needs to happen, the capital that is required, the lack of public funding, and the need to be mobilizing commercial capital. So that's definitely an area where we feel we have to lean in. And then more specifically, the problem is very much at the early stage and greenfields risk, where the commercial investors are less willing to be coming in on. The product which we are then sort of looking at is very much along the lines of what David outlined, which is risk capital. So we have found that on the senior credit end of the spectrum, there is plenty funding available, but there is a lack of bankable projects. There is a lack of risk capital, which ultimately brings projects to investability. And that is very much what we are looking to be providing. which is then very much encapsulated in the strategy that we have recently launched, the British Climate Partners, where we are focused on the energy transition, generation, transmission, distribution, and e-mobility across South and Southeast Asia, providing equity into equity platforms, which we are setting up. We recently launched an equity platform in India alongside a partner called Copenhagen Infrastructure Partners, which is a private equity partner, where we're looking to be developing energy generation projects in India. And we're also looking to provide mezzanine-style capital very much along the lines of what we did with IB Vogt, in order to be supporting players that are already in the market but are grappling to be growing their business for lack of risk capital. And the last one on partners is always critically important, and I'm very pleased to be joined by two partners. So obviously IB Vogt and David here, where we found a very sort of aligned thinking in terms of what the business focus is, and also the way that the business is being executed, as well as the FAST-P program, and Gillian through Pentagreen, which is a co-investor of ours in the IB Vogt transaction. So this is really, I think, encapsulating very nicely the constellation and the combination that we are looking for in order to be addressing those issues, because I think it's obvious that none of us single-handedly would be able to be approaching any of these issues, rather than it takes different partners, different kinds of capital, different kinds of capabilities to be coming together to make a contribution.
No, that's great. Thank you very much, Holger, for setting out so clearly the different kind of elements. If we come to a kind of quick fire round, we've talked a bit about it, but Gillian, maybe to you first, in terms of if you had to name one barrier that most needs solving, what would it be? And then I'll come to David and Holger.
It's a great question. I think it is the addiction to bespokeness. So Holger's absolutely right. We cannot do this alone, and you need the partners. The trouble is each partner has their own way of doing things, and I think we end up having to have very bespoke transactions, platforms, negotiations each time, and that creates frictions and inefficiencies in the system.
No, that's great. David, from your perspective?
Well, I would say in the markets where we're active, it's still the regulatory framework, which is improving. And a positive example is I think, the Philippines, where there's been a very structured regime for the last 5 years. But we're still lacking that in some of our other markets. And I think for private companies like us, predictability in markets and regulatory regimes is really the most important part.
And Holger, from your perspective?
Yeah, I think I would go with the challenge to bring domestic capital into the space. Mostly we are attracting international capital, which is amongst others here. But and ultimately infrastructure should be owned by domestic institutional investors. And that is where I think there is a barrier, in particular in Southeast Asia, to have investable structures and products, where insurance companies and pension funds can be crowded into infrastructure investments.
And you see that as quite different to the international angle, or?
Yeah, no, definitely. I mean, even within the Asian region, I mean, India, I think, is a very good example as to where significant progress is being made there. They have introduced legislation to allow for yieldcos, which are called investment trusts in India, which really connect domestic pools of capital to operating infrastructure assets, which are the natural owners of these types of assets. And that does ultimately make for very efficient funding of these assets, which the North Star investment that I had mentioned earlier is very much predicated on this, so that we are originating assets and ultimately are selling those assets post-completion to these types of investors. So there's good examples that one can follow, and I'm very hopeful that we could make some progress in this direction in Southeast Asian countries.
No, it's great to hear about accessing the local investors, as well as obviously all the kind of work that's been done with the international investors. And as a final question, looking ahead, as you think about one thing you would most like to see, kind of the flip side to the barrier question, most like to see from the different actors within the space, whether that's investors, policymakers, DFIs, or other partners, what would you like to see to scale climate investment? Maybe firstly to you, Holger.
Yeah, look, I think I would just lead on to what I had said. I mean, I'm passionate about, the value chain that you have to look at. It's really to fix the entire thing, from project development to finance, execution, but then also to the ownership. At the back end, I think in particular in more sophisticated markets, relatively speaking, emerging markets in Asia, is really critically important. And that does require benign policy and regulatory action, which includes tax incentives, to ultimately really unlock the capital that is available in the countries, which will then also have the potential to address the currency challenge. Because obviously if we are funding infrastructure projects in hard currency, i.e. currencies that are not originating in those countries, it always creates another barrier for investments. And by developing the domestic capital markets, we can make a contribution to overcoming that.
No, great. Gillian, from your perspective?
Yeah, I think greater openness to alignment would be really helpful. And I mean that among the partners and the folks that are active in our ecosystem. And this actually relates to points that a few of us have made on this panel, which is that if we want to bring in that institutional investment piece, they need to see much greater, I guess they need to develop much greater familiarity in the products and the structures and the standards we use. And it really helps if we, the ones who are active in this space, who are putting out product in this space, can actually align among ourselves. So what we found in FAST-P, and to be honest, that's been an interesting insight in itself, is that, DFIs, there's a great variance in how DFIs work, the standards they expect, their interpretation of sort of common standards that have been put out there. And that in turn, I think, leads to very protracted negotiations, even at the fund level. And if we want to scale this and we want to make it repeatable, we can't afford to go through this process again and again, right, for the amount of investment needed. So, my hope and dream is really one day to get all of us in a room together and kind of align on some basic parameters, whether that's, on additionality or what we expect to see with impact and mobilization. I think that alignment would be super helpful. If nothing else, as a starting point, it's been interesting that when you look across DFIs and other investors and philanthropies, they've got quite different reporting requirements. So, requirements for the fund to report on. And disclosure and reporting is very, very important for transparency and for learning. And I think this is an area where we could afford to maybe find a common standard, have it built out in a practice sort of guide of sorts, and then, really kind of have that implemented across the board. So much more alignment.
No, and look, I think we're very much in agreement with you, and obviously given the kind of size of the problem and there's limited capital to use, particularly in the concessional space, absolutely looking to work with other DFIs, other MDBs, other partners in this space to be able to move faster, more consistently, and absolutely create kind of common standards between us. So totally agree with that as a key focus area. David, from your side, what would you say?
Well, I would agree with Gillian on the efficient reporting, and
Yeah,
besides that, I would maybe follow up on the on the regulatory framework. I think we are quite on a positive path in Southeast Asia, and I hope that continues, and that's also initiatives like FAST-P and what BII is doing is very important for that, to work with governments and regulators to keep the momentum.
Great. Well, thank you so much for joining the panel, and thank you for sharing your expertise and your different viewpoints on the region, both from the development side and from the kind of international and local investor side. We very much look forward to working with you and seeing more in this space and more capital moving into the markets. Before I hand over to Huma, we're going to see a quick video from RISE, one of our investees in Indonesia.
Rice is actually the biggest contributor of emission from agriculture in Indonesia, and it contributes globally more than the aviation industry emission combined.
We launched RISE in March 2023. RISE was formed with other co-investors with a mission of decarbonizing rice cultivation and improving the livelihoods of the over 100 million smallholder farmers that produce rice in this region.
Instead of flooding their field the entire season, RISE team helps them to dry their rice field at certain times during the production cycle. And this helps to reduce the emission from the ground, but it also actually leads to a better, more productive crop.
Saya sudah bertani padi sejak tahun 2009 dan 3 musim terakhir sudah bermitra dengan rice farm. Yang pertama, tanaman padi saya lebih sehat. Yang kedua, lebih tahan penyakit. Yang ketiga, tahan roboh karena dia akar padinya lebih panjang. Dampak yang kami rasakan adalah meningkatnya pendapatan.
Rise has grown to $50 million in annual revenue, servicing over 18,000 farmers and 19,000 hectares in Indonesia and Vietnam.
BII is a very, very respected DFI. And so as a result, what that has enabled us is to open many other doors. BII became a real instrumental partner to help us get to a final close.
Thank you to both our panels. Hopefully those thoughtful insights gave you a sense of why we're so excited about the partners we work with. We've now reached the time for the Q&A with our CEO and Chair. Thank you to everyone online who has been submitting questions. We have had a lot come through, so I might merge some questions into broader themes. And where I can, if you've provided your name and organization, I'll attribute the question. Diana and Leslie's presentations have prompted some excellent questions, and as usual, they reflect the diversity and depth of our work. So let's get started. My first question for Diana is, given the increasingly complex global environment described in the annual review this morning, how do you see BII evolving its role over the next strategy period to maximize both development impact and the mobilization of private capital, particularly in frontier markets?
So I think my answer to that would be these are both critical areas of our future strategy. As I've said, frontier markets is core to us, has always been core to us, but it's also very important for the government and the broader community. And so we've agreed to allocate at least 25% to frontier market investment. In terms of mobilization, frontier markets are a harder place to mobilize investment, and our mobilization there tends to be focused more on, frankly, mobilization of existing development capital, making sure that we work effectively together and bringing in new partners there. For broader commercial capital mobilization, what we have really focused on is how we do that within the climate space, which is where really significant billions and even trillions of dollars are needed. And that's why we've built our focus on Southeast Asia, but also on BCP. So British Climate Partners will allow us to work with commercial investors to help them de-risk and attract that investment into that new sector.
That's great. Leslie, do you want to add to that, given that this is core to what we're doing?
Absolutely. I mean, as you know, in the last strategy period, BII has already been very active in these markets. One of the key pathways through which we embark on our approach in these markets is partnerships. So, whether it's the ARIA partnership that we have with Proparco and with FMO, whether it's with the Africa Development Bank private sector operations, we have a whole series of development finance institutions that we work with in close collaboration. I guess what I'm saying is that these markets are difficult, they are hard, but we need approaches where we can co-originate, for example, where we collaborate on the pipeline generation. Each of our institutions have different risk appetites, right? So we try to be complementary in our approach. Some of the development finance institutions, for example, work with the governments on policy and regulatory design, which creates, a more stable, enabling environment for us to do investments. So we try to work together in more imaginative ways going forward. And then more importantly, as Diana has said, we have very much country-specific approaches in many of these markets. For example, we have mobilized successfully, as I said in my remarks earlier, from local pension funds in Ghana, for example, as well as in Zambia. In those markets, it requires painstaking relationship building, and we have demonstrated it through GIP in particular, which is the finance vehicle that we have created in Zambia and Ghana.
Great, thank you. So moving from frontier markets, which is one topic central to our work and to the upcoming strategy, to another one, which is gender lens investing. So Leslie, we have questions about how BII is supporting gender equality through its investments. Could you speak to that?
One of the areas that BII, the leadership team, the board, FCDO, that all of us are very proud of, is the very distinctive and pioneering leadership role that BII has played over many, many years in this domain. This culminated in 2018 when BII was very central in designing, co-creating, but designing, being the core architect of coming up with criteria which has now essentially been mainstreamed, which has created sort of the concept of gender lens investing. What this means is that we have a set of metrics. We look at an investment through the lens of are there women in the leadership, in the board, with respect to the ownership. Do women have equity in this business? Does the business employ women? Are there distinct financial products that the business have come up with to target women clients? So all of these, we have created a framework which now go beyond just ourselves and the DFIs. It has been mainstreamed in corporates and portfolio managers who apply these criteria. So our impact goes much more beyond the individual investments that we make. We set a much higher bar for ourselves to assess our impact. So in short, what I'm saying is that we have helped create the ecosystem around gender lens investment, and we are raising the bar internally in the new strategy to continue with this impact.
Great.
I think it's worth pointing out that there's that is the absolute macro framework, but we are also continuing to look at gender within our own investments, working closely not on the specific just on the specific investments themselves, but helping those investment D companies, once they have been invested in, to continue to expand opportunities for women and be very thoughtful about this. So I think it's both pieces are still very strong.
Yeah.
Thank you for those responses. We have more sort of linking to these core strategic pillars for BII, so moving from gender to climate. We've had a few questions through about whether and how we work with local partners in the climate and infrastructure space. I'll call out one from Saloom Awad, so thank you for that question, asking about this aspect of local partners for climate and infra.
Maybe I'll kick off. Firstly, I think it's important to highlight that, despite the sort of, politics around climate, right, the economics have driven a movement that is kind of unstoppable, right? Throughout our markets, we have been able, in 2025 alone, to deploy more than $1 billion, for the first time over $1 billion in one single year in climate finance. We're able to do this on the back of real significant opportunities that we see in all of our markets across Africa, across South Asia, Southeast Asia, and so on. And here I'm referring to both early stage, where there's just flurries of clean tech entrepreneurs coming up with new ideas. We're seeing it through our funds, for example, and we look at businesses that we are beginning to scale. We have done investments, as you know, significant investments in the electric vehicle space, charging stations. Just a few months ago, together with the board, Anna and I and the board went to Accra and we went to Lagos, visiting some of these companies. We went to a two-wheeler motorbike sort of charging station and spoke to the founders, those entrepreneurs, about how they scaled their business and the expansion and so on. And we were able to do this, understanding the local domestic context, because there are opportunities that are enabled by local regulation. Let's take the example of Ethiopia, where I was 6 weeks ago. We invested in a company there called Dodai, which is a motorcycle assembler. And that was done because the government took a view. They will simply, from one day to the next, they banned the importation of all ICE vehicles, internal combustion engine vehicles, which created an enabling environment for EVs to emerge. And that company, in a short space of time, managed to sell 2,000 units and growing and employing hundreds of workers. In short, what I'm saying is that we see significant opportunity to partner with local players to scale these businesses.
Great.
Just turning to that on the infrastructure side, I think you see local partnerships across literally every piece of the investment, from assessment of opportunity, environmental impact, working with local community partners, to around those infrastructure projects, as you asked, local partners as core developers, involved in the construction. So you really do see them across. We have local partnerships across the full spectrum of our projects.
The theme of partnerships is one that's provoking a lot of questions, so I'm going to stay with that. And I think this is a question we can start with Leslie and then Diana. I'd be interested in your views as well. Catherine Brassel is asking, in terms of furthering partnerships, what are the untapped partnerships and where might we look to unlock new partnerships?
I think it's fair to say that, as you know, BII is one actor within a development finance system. We have worked for years alongside FMO, Proparco, Norfund, Swedfund, all of our European peers, as well as FinDev Canada, and then also other multilateral banks. But each of these institutions, we have our own risk appetite statements, we have our own sector sort of priorities. And we have tended our own development impact metrics, for example, and we've tended to function in a very siloed way, which has complicated matters for especially investee companies who have more than one DFI as owners, for example, because they have multiple reporting requirements. That it adds to the transaction cost. So the time between pre-screening and when a deal is actually assessed and when it's done takes much longer because of all of the different sort of processes. So going forward, we are now looking at much more deeper collaboration across the industry. There's conversations right now, for example, underway where we are, for example, putting in place what's called a friendship facility, where essentially, and we call it also follow the lead, where if we are leading on a transaction, and let's say FMO is a fellow investor in that particular company, they will simply follow the lead and trust the credit processes or the rigor of our due diligence process and not go through another set of analyses. In short, we are now looking at, and we will continue to look at and refresh the models to deepen the partnership amongst the DFIs, to make it simpler and easier also for commercial institutions to deal with us, because we are often perceived as a little bit bureaucratic and sometimes slow movers. So there's a great focus on becoming more efficient, more agile, and more nimble.
I agree with Leslie that it's the partnership model in that area that is evolving the most. In terms of new partners, I think the way in which we work with very local partners, whether that be local pension funds or others, is changing to be a much deeper and more profound network. I think the other area is around commercial financing partners. For years, DFIs have had relatively little overlap with the commercial funding world. Obviously, in the climate space, we're seeing that change, and we're seeing a really key role for DFIs to be able to de-risk and unlock and to lead in various forms of assessment. So I think it's that collaboration that you'll see in BCP, but the broader collaboration with commercial partners in the climate space that is also a new area.
Thank you. We've been spending a few minutes on partnerships, but we have a question that's asking a bit of a contradictory approach, which is what distinguishes BII from other DFIs? So how are we different?
Well, I think we're different in a couple of respects. I think one, firstly, we recognize the importance of investing in markets that are riskier and where capital is really scarce, and unless the DFIs enter those markets long-term will become uninvestable and will create a whole series of challenges that downstream. So the first point is that BII has consistently been a significant investor in the least developed countries and frontier markets. And as you know, as we mentioned in our remarks, we now have a target of up to 25% of doing that. Secondly, BII has also been an equity investor in many markets where traditionally DFIs have been reluctant to invest because equity is the riskier parts of the capital stack. So in other words, we move from the conviction that equity is vital in capital formation, and you cannot just lend to companies, you have to create companies, right? So it's important for us to play that role of that market building role, where we invest in businesses. As those businesses grow, they're able to attract and bring in others.
Dan, I'm sure you want to add.
No, I think it's an excellent answer. I think the only thing I'd add there would be because of the equity and the fact that we have a wider range of financial instruments, we probably have more flexibility than many other DFIs across the capital stack. And I think the other I'd say is I do think BII has had a history of real innovation. Some of that innovation has been around putting science behind scoring for impact, but some of that has also been around building of new platforms, and IANA on the solar front is an obvious example of where I think through those combination of things we've been able to take much higher risk, go out and create platforms to drive into new areas.
Maybe just to add also, Uma, we, as you know, make direct investments, but we also recognize that we can reach a much larger universe of companies through investing in funds. That has also been a differentiator. BII, through many of these funds, we were one of the early and often the first anchor investor, LP, in those funds. So we have over these years, what has given us a distinctive, unique positioning. We have created almost, or played a key role in the creation of the venture capital, the private equity industry on the continent. So we have always embraced this idea of being architects and shaping markets and building the ecosystem, not just doing direct investments and hoping those businesses succeed so that we can grow those companies, exit, recycle our capital. We also look at making that broader market shaping impact.
Okay. I think we're starting to come to the end of our conversation, and we've had a question come through sort of linking to the point about innovation in our impact space and the impact frameworks that we've developed. And this sort of goes to the heart of BII's mandate, the question of how do we balance the mandate to deliver financial returns for the UK taxpayer with development and impact goals. Diana, would you like to start, and then to Leslie?
Sure. I mean, in some sense, this goes to the heart of what makes a DFI. And really, for me, the magic of development finance is to be able to do both of those things at the same time. So I think it really is a balance. There isn't an intrinsic tension. Really being able to deliver a sustainable return is important to be able to keep investing that capital. But it's also important at an individual business level. If a business isn't able to be successful, it can't create that impact. So that ability to make a business, to help it be successful, is absolutely critical. So for me, this really is the core of what we do. I think we've shown over nearly 80 years that we can manage that balance. And I think it is not something that is intrinsically, as I say, in tension. It's something that is critical to see both halves, and we focus on those. But the key to everything is leading with impact. So impact is the leading indicator. That's the thing we focused on most. Financial sustainability is a sort of necessary way to get to that impact.
Maybe just to add to that, Diana, one of the metrics that I think we are now, as not just BII, all of the other DFIs are faced with a similar kind of challenge. We are living in a period where resources are more scarce. So making sure that being very intentional about that additionality, making sure that we are not financing anything where other commercial players could have stepped in. So when it comes to de-risking, where there's almost an implicit subsidy in order to crowd in other commercial investors, we put rigorous criteria in assessing whether that financial additionality warrants the equity that we would put into a business if it could have come from somewhere else.
And that's the impact point. If we aren't additional, we don't have the impact. We wouldn't do something for a financial return basis.
So rigor, innovation, additionality. We've covered a lot of ground in the last few minutes. But I'm afraid that was our final question, and I want to thank you both, Leslie and Diana, for your candid responses. I'm afraid that's all we have time for today. Thank you for all your questions, and I am sorry if we didn't manage to get around to everyone's. We do very much value your engagement during these sessions. I know that many of you will keep the conversation going with us in the coming months, and we look forward to that. To conclude our event today, I would like to hand you back to Diana for her final words.
Actually, my final words are really words of thanks. First, to our partners across the UK government and FCDO. Your support and collaboration, as you know, are fundamental to our work. To our board colleagues for their guidance and stewardship, and critically to the team here at BII, whose expertise, professionalism, and absolute commitment underpin everything that we achieve. Thank you to all of you online for your continued engagement, scrutiny, challenge, and support. That dialogue really does help us continue to improve and deliver greater impact. As we look to the future, I think you've seen from the panels and from everything we've discussed today, our purpose remains clear. BII is here to invest where it matters most, where capital is scarce, where opportunities are uneven, and where that long-term capital and partnership can unlock lasting change. Thank you for your time today, and we look forward to working with you over the next year.